Microphone check. 1, 2. All right, guys. Hey, we didn't know we were going to have to start with this, but a true investing legend passed away. I don't know, like within the hour, we got word. And we're still going to do everything that we were planning to do tonight, but wanted to make a little bit of space to talk about Charlie Munger, on the Mount Rushmore, I would say, of investors, legends. 99 years old. He almost made it to his 100th birthday, which I think would have been January 1st. So just an incredible, legendary investor. We're gonna talk about that in one moment. But first, Michael, let's thank our sponsor of this week's show.
So the sponsor for today's show is U.S. Benchmark Series ETF. They allow you to target specific maturities, specific parts of the yield curve. And check this out. They roll each ETF to the newest Treasury security as it's issued, and that rolling process realizes capital losses and defers any capital gains. To learn more, that's the magic of ETFs. To learn more, go to USTreasuryETF.com. That's USTreasuryETF.com.
Very cool idea for a product. All right. So look, this was a day that everybody knew was coming. This is, you're talking about a 99-year-old person who has has seen a century. And I thought it was interesting. This weekend, I finally got around to listening to the Acquired podcast. This might be his last interview ever.
Yeah.
So they had him. So let me give people a little bit of background. Charlie Munger has never been on a podcast before. He did his first podcast. Michael, I know you're friendly with Andrew Marks. It seems like Andrew Marks put the Acquired guys into Charlie's dining room to get this done in Los Angeles.
Pretty cool.
And then you hear him in the background throwing out some questions. But Charlie had dinner, but spent like an hour or more talking about some of the greatest investments of his career, the relationship with Warren Buffett. So if you really want to do a deep Charlie Munger dive, that's his latest thinking on everything from China to Costco to Home Depot to anything. So I would definitely point people there. What's the first thing that occurred to you when you heard the news?
I guess it's hard to be surprised when a 99-year-old person passes, but you just heard him a couple of weeks ago, and his voice was a little bit tough, but certainly sharp as ever.
Yeah. He had a lot of Yogi Berra-isms. He had a lot of really great sayings that on their surface they were a little bit silly or paradoxical, but the more
people don't go there anymore, it's too crowded.
Yeah, he had a lot of those types of sayings, but there was so much depth. I'll hold that up.
So who got this for us?
Somebody sent. We each have a signed copy from Charlie Munger, which is pretty dope.
So it says for Mike, and he signed it. Yeah. Was this Ed Borgato?
I don't know, but we got
I feel bad.
Somebody sent that to us a year ago. What an amazing gift.
I feel bad that I can't remember who got this for us, but I was.
Now the problem is he thought he was signing it to Michael Jordan. So I don't know if you're upset about that.
I was thumbing through this, and believe it or not, I've never read this. I mean, it is definitely a tome. It's a coffee table book. It's not something that you.
This is Poor Charlie's Almanac.
So this is Poor Charlie's Almanac. This is the 3rd edition. I don't know when the first one came out, but I was just thumbing through it, and the foreword is written by Warren Buffett, and I won't read the whole thing, just the first 2 sentences. He said, from 1733 to 1758, Ben Franklin dispensed useful and timeless advice through Poor Richard's Almanac. Among the virtues extolled were thrift, duty, hard work, and simplicity. Subsequently, 2 centuries went by during which Ben's thoughts on the subjects were regarded as the last word. Then Charlie Munger stepped forth. Yeah. And it's only 2 short pages, but Charlie Munger wrote a rebuttal.
But listen to this. Though, stop thumbing through that, by the way, because I don't know what that's going to be worth, the book. Maybe put on a pair of gloves.
Listen, so Charlie Munger wrote a rebuttal. And again, I won't read the whole thing, just the first couple sentences. He said, I think there's some mythology in the idea that I've been this great enlightener of Warren. He hasn't needed much enlightenment. I frankly think I get more credit than I deserve. it is true that Warren had a touch of brain block from working under Ben Graham and making a ton of money. It's hard to switch from something that's worked so well. But if Charlie Munger had never lived, the Buffett record would still be pretty much what it is. And what Munger is referring to is the credit that Buffett has given him for extolling the virtues of not buying a fair company at a wonderful price or a decent company at a wonderful price, the cigar butt style of investing, but buying wonderful companies at fair prices. And that was a gigantic shift from what he did in the early days of his partnership in the 1950s.
Right. So Buffett has given Charlie Munger credit for the unlock, whereby Buffett went from buying. The cigar butt thing is a very specific thing, which was really like, okay, we know this company is already dead, but there's a couple of puffs left, like picking up a cigar off the floor.
There used to be actual companies that had more cash, like literally more cash in the company than it was worth alive.
Yeah.
And so those sort of inefficiencies obviously disappeared a long time ago. But when they did, Munger said there's probably an easier way to do this.
Right. So he gets the credit for that. And without that insight, there's probably no American Express investment, probably no Coca-Cola, definitely no Apple. So Warren's strategy changed from the hardcore Ben Graham discipline of only buying the cheapest securities to something where, okay, you're willing to pay up a little bit, but there's got to be a really great brand or great company underlying. And that's really if you ask me, having read maybe a lot, but not the most about the success of Berkshire, but I've read my share, that unlock is the one that really made the huge difference. And I think separated Buffett from a lot of the other value investors of that era, of which there were many. So,
you'd say that Charlie Munger is, I guess him and Warren, probably him, the most quotable investor of all time?
Yeah, him and Peter Lynch probably are the two that, like, in the popular parlance of traders, investors, et cetera, like you'll hear somebody say something and not even realize that Munger said it first. I want to give people a little bit of a background. Charlie Munger, in addition to being the vice chairman, this is from CNBC.com's obit, was a real estate attorney, and he was the chairman and publisher of the Daily Journal Corp, which is a newspaper. He was a member of the Costco board, and I mentioned a podcast that he did a couple weeks ago. He spent a lot of time talking about what made Costco so obvious and so special. He was worth about $2.3 billion, according to CNBC.com at the start of this year, which we forget. It's a huge amount. Buffett's worth 120, so the two are not comparable. But 2.3 billion is a pretty gigantic number. And, obviously most of that is from the appreciation in Berkshire Hathaway shares.
As I was thumbing through this book, this is just a great example of like, who is Charlie Munger? Somebody asked him a question, do you use a computer? And he said, I don't. I do have one in my office, but I've never turned it on. In fact, I wouldn't even know how to plug it in.
Right.
In my life, there are not many questions I can't properly deal with using my $40 adding machine and dog-eared compound interest table. He's like the only, when you think of investing wisdom, which has become sort of taken hostage and turned a little bit cheesy, he's really the founder of all of that wisdom.
Yeah, I also think he's a guy that never changed, and he gets a certain amount of street cred for that. Like, this is not a guy that, like, in the 60s and 70s was saying one thing, and then when the 80s came along, started doing all these LBOs because it was fashionable. Like, he never pivoted to becoming, like, a tech guru or a macro. Like, he really just always focused on investing in great businesses.
Hated.
He has opinions, but he wasn't, like, changing he wasn't changing what he was doing based on the times around him. He really stayed true to what he always said he was about, which I think is very rare.
An old soul, someone described as cantankerous. He definitely, I don't know that he hated Wall Street, but I don't think he cared much for investment bankers. Definitely hated consultants.
Yeah. Yeah, and then some of the last comments that he made about investing, people, were asking him on a consistent basis, like, has it gotten harder? He said, it was never
always hard.
easy.
Yeah.
And it's harder now. Like that was a great Munger quote. Like it was never easy, and it's even harder now. So he doesn't think that there are no opportunities for investors, but I think he's been very circumspect. His point is you cannot have trillions of dollars chasing opportunity and everybody getting a happy ending. There's just the industry is bigger, the amount of hands in the pot are more plentiful, and it's just not going to be true that all these people who are claiming expertise are going to be able to deliver for their investors. I don't think that's an irrational comment to agree with. I think it's a pretty easy comment to agree with.
So
it's not popular to say that on Wall Street.
His legacy will be that of the number 2 at Berkshire, the number 2 to Warren Buffett, and probably the greatest sidekick of all time.
I would say so, and I could only imagine what today and this the rest of this week will be like for Warren Buffett. This is like somebody who's been a constant in his life as much as his 3 children, and it's got to be it's got to feel like almost more than the end of an era. It's like the end of a lifetime, given how long they've been working together. So our hearts go out to the Munger family and all of the shareholders who had gotten to know him over the years, and anyone whose life he touched, which of course is probably 1 million people, investors, business owners, etc., and Warren Buffett. So that's our brief but necessary encomium to one of the greatest investors of all time. We may have more to say on this later this week if we can get our act together. Okay, let's do the show. I think Charlie would have wanted it. I think Charlie would have wanted it that way. Okay, year-end rally looking to me like a slam dunk. Of course, anything can happen out of the blue geopolitically, but absent any kind of exogenous event, I don't see why this year would be different from most years, which is a lot of active managers in a position where they have to do something more aggressive than they've been doing all year. And what that ends up looking like is a race into the fastest growing, highest flying stocks. It's not novel. It's not unique to 2023. But that's my baseline. That's what I expect to see over the next 4 weeks. What about you?
So what's happening? Why should this year be any different?
Yeah.
Now, of course, who knows? Exogenous events happen all the time. But assuming no news that shocks the market, the chase is on. That's just what it is.
Willie Delwich at High Mount said, for the first time in 16 weeks, last week had more stocks making new highs than new lows. In bull markets of the past, greater new highs than new lows was the rule, not the exception. This is like one of those statements that on its surface is obvious, but people almost drift past this. They shouldn't. This is really what it is. This is what a bull market is.
Can you say that one more time?
For the first time in 16 weeks, last week had more stocks making new highs than new lows. So he's talking about 52-week lows versus 52-week highs. It's been negative, that equation, until last week. And in my experience, it's probably not likely to be a blip. It's probably going to be a sea change. And why that's great is there are a lot of stocks that have not had a good year, especially when you look at it relative to, let's say, the NASDAQ 100. So that's what I think you're going to see.
You know what we just had for the first time in a long time, in a relatively long time? We had a V-shaped recovery.
The October 2023 low to today,
The October sell-off was straight down.
Yep.
Effectively, we were down 9 out of 11 days, and we came straight back up. And it's the first time that's happened in quite a while.
I really think that my mutual fund tax law selling idea was the reason why it looked that way in October. I mean, it's easy to say in hindsight, but that's really what it was. I didn't think there was anything fundamental going on. We got a benign inflation print, so that was important. And maybe we got softer rhetoric from a couple of Fed heads. But I think the real thing that happened was people stopped doing tax law selling toward the end of October, and there were no sellers left when the month turned over. If you look at a chart, that's what it looks like.
I mean, that is purely fitting a narrative to what happened.
This is what I do. I'm
Right,
one of the
you're good
best
at
in the
it.
world at it.
You are very good at it.
Ari Wald at Oppenheimer, one of our favorite technicians, talks about something that I think also gets overlooked or people really are not fully aware of. Technology almost always leads true bull markets. So before we pop this chart, let me just give you Ari's actual word. Our feel is that bearish investors that largely missed the S&P 500 gains in 2023 are gravitating toward the Russell 2000 in belief there's greater potential in lagging benchmarks. He disagrees, but he points out if you're going to do that, you might want to do that in small cap tech. Technology has outperformed during 20 of the 23 bull cycles since 1932. This means that in a bull cycle, tech usually outperforms. That's why the S&P is benefiting. It's got 27% weighted toward tech. Russell 2000 has too small of a technology proportion to keep up.
Hey, you know what?
Go ahead.
Are there any small cap sector ETFs? So
Nope.
like XLK is at an all-time high, right there.
There's not. I looked. There is no explicitly Russell 2000 tech ETF.
Opportunity?
You could launch it. Nobody. I mean, it's going to be a collection of garbage. You know what I mean? Like small cap tech is super dicey. Like it's not going to be a great long-term investment strategy. Is it tradable? I think this is the environment where it is tradable. These are stocks that are involved in some of the hot themes, but they just haven't done anything. But we're going to show you some of these names right now. Let's pop. First of all, let's pop this first chart. Russell 2000 technology. So if you were going to build a Russell 2000 tech ETF, this would be the index that you're basing it on. And
But on the bottom, it looks like it's breaking out relative to the rest of the Russell 2000.
That's what we're
about
saying.
to.
That's what Ari's showing, coiled and ready to spring. So Russell 2000 tech versus Russell 2000. The next chart is some of Ari's favorite small cap software chart. Some of Ari's favorite small cap software, individual charts. I don't even know what these things are. Braze, BRZE, Couchbase, okay?
It's my biggest holding.
Freshworks, and Elastic. And none of these are in uptrends. These are all basing. These are all stocks that are basing, but look like they've cleaned up their sellers.
Well, so let me ask you this. Let me ask you this. So assuming that the rally continues to the end of the year, chart off, please. Would you rather buy the leaders? I'm just talking for the next, 30 days. Would you rather buy the leaders or the losers that stopped going down? And two of the losers that stopped going down, like, for example, like Target or Dollar General. Like, would you rather buy the losers or ride the winners?
So, like, not to be a dick, but I'm already in the leaders. I know.
Do you own
you're
Uber?
gonna get mad at
Do you own Uber?
Yeah, it's up 100% this year. I'm in Nvidia. I'm in CrowdStrike. I'm in Apple. Like what? I'm in the leaders. You know what I'm saying?
All right, but if you weren't, not to brag, if you weren't.
I'm just saying. Yeah, because
Yeah, what? Yeah, what?
Yeah, I would buy the leaders again if I wasn't, or I'd buy the leaders that I don't own. There are plenty of them. I'm not in everything, but I bought Zoom and PayPal, which are two of the biggest laggards of the year of the last 3 years.
Zoom is such garbage.
You're going to be so wrong on that. It's embarrassing. I bought PayPal. You and I talked about it.
Time out. I'm not making any forward statements about Zoom. I'm saying it looks like shit. You might be right.
Shit. No, it's shit, but it's 14 times earnings shit. So I think it's been de-risked.
Oh, but at least it's not growing. It has that going for it.
Dude, they have they have like
I know
billions
the
of
big
dollars in
contracts
cash.
are growing. Oh, yeah.
No. Barely growing. Barely growing. Doesn't matter. The balance sheet is great. They have time to figure it out. They have a new CEO.
The balance sheet. Have you learned nothing from Charlie Munger? You poor son of a bitch.
Charlie Munger. It's one of the first things I look at. All right. One thing that I'll say, in the case of PayPal, Affirm and Shopify have absolutely left that stock in the dust, and they do the same thing. They're in the buy now, pay later business. Yeah, it's sick. Affirm, there might be a really big short squeeze underway in Affirm. I haven't really looked. Shopify's left orbit. PayPal's in a lot of the same businesses. And we could talk more about that later. I wanted to show you this. I had Sean put this together. So if you're asking, like, what are the Russell 2000 tech stocks that we're even talking about, here they are. These are the 10. Let me explain what this is. These are the 10 highest volume in terms of daily trading in the Russell 2000, not the best or the biggest. So SoundHound, which is AI, and C3, which is also AI, no surprise. Those are trade. I think this is the biggest dollar volume, not share volume.
But that doesn't look right. Not to question Sean's work. $9 million. That's like $0.
That could be more. That could be in billions. $9 billion worth of stock changing hands.
No. The market cap's probably not even that big. Either way.
No, it doesn't. The market cap doesn't have to. The market cap is turning over multiple times in some of these stocks.
Not a
per day.
No chance.
We'll find out. All right, these are just the highest volume.
Be that as it may.
Trying to make. Go ahead. Do you know any of these stocks? Do you know any of these stocks besides C3 AI? Do you know Array or Backed or any of them for that matter?
I bought AI.
SunPower.
So for example, I'm looking at SoundHound.
Yeah.
Its volume today it traded 7 million shares today. So
SoundHound is. I'm not like in the stock, so I don't want anyone to take this and say Josh is pumping sound. I don't know anything about recent fundamentals on it. I don't follow it. I know what the business is. SoundHound is like when you call a restaurant to order takeout. This is why I know this. When you call, I called Anthony's Coal-Fired Pizza the other day.
Dude, that place has great wings.
Yeah, great. That's what I eat. Low carb. When you call there, you don't talk to a human. You talk to, it's probably SoundHound. You talk to an AI. You tell it what you want, and it asks you follow-up questions like, do you want the sauce on the side? Or do you want to give me a credit card number or pay in cash when you arrive? Your entire interaction is with an AI voice robot, and you know how I feel about this. It's way better than dealing with a regular person.
What if you wanted drumsticks only?
No flats?
Oh, you call them flats?
Yeah, what do you call the other part?
Wings?
Oh, no, the whole thing is a wing. The wing is...
No.
Let me teach you something that you clearly don't know. The wing
no, this
is
part,
bisected.
that's the wing. That's the wing. That's the part that I eat.
Please. No. The wing is bisected. That's not an actual drumstick, that part that you think is a drumstick. It's not its leg. It's part of the wing. It's part of the wing, okay? This is the flat, and they cut it in half. And so that's how you get those two parts.
Part of the wing. You're blowing my mind right now.
You break it in half, and you get a flat, and you get a drum. That's two of those put together is a buffalo wing.
The more you
Savvy?
know.
Okay.
Yeah.
All right. Moving on. C3 AI. I predicted that this stock would be one of the big bubbles of the year. This is, I think Tom Siebel is the founder of this, if I'm not mistaken, who's had another successful public company eponymously named. But C3 AI is,
it's not a bubble. It's not a great bubble. It's really not.
No, it's not.
This
is a wild, so this is from inception though. Look at this. Next chart.
No, it's year to date. That's inception. Yeah. Yeah, not a bubble.
Yeah. This has been a rock and roll stock. This C3 AI is up 128% this year. Up 159% this year, which but still nowhere near the 2021 highs. Chart off.
No.
It's pretty impressive.
Are we good?
I don't think it's a bubble either. I saw their earnings results. They looked pretty good. This stock could be way more expensive based on how excited people are over AI. They haven't really run it up yet. So I don't think I was right in that call.
All right, so we got a volatility smash down. Where's the VIX at these days? Under 13? Right about at the lowest of the year? Kind of incredible.
We hit 20 on October 7th. That's the last VIX spike.
It was, October 23rd.
Where it says Hamas attacks. That was the last big VIX up move.
Yeah.
And nowhere near the peaks from the Ukraine invasion.
No. So it's not just like that the VIX is broken or it's measuring something different than what people are trading. Like the actual volatility of the S&P is pretty low. So next chart, please. It's just the 30-day standard deviation, and it's on the rise a little bit. But the stock market's been, in terms of just like,
what is this S&P 500 30-day standard deviation 1%? So that's like the average move, or the average move relative to the norm. Like that's just
that's a
the
great
average.
question.
That's the
standard-
average 30-day move.
So what the standard deviation says is if it's plus or minus one standard deviation from the mean on like a normal bell curve, that 68% of all observations would occur within that time frame or that like that band.
Yeah.
That's what that means.
So, but that's looking at it on a 30-day basis.
On a 30-day basis.
Yeah. It's hard to get too bearish just because vol is low. Like if that's your reason, it rarely works out. But you rarely want to buy like peak tranquility either.
So I'm glad you mentioned that.
It's a delicate balance.
I'm glad you mentioned that. Like some people would view a low VIX as like can't buy now, but people are complacent. And I feel bad. I feel bad. I grabbed this chart and I wish I could. I grabbed it like 5 minutes before the show and gosh, oh here it is. I was about to say I forgot who tweeted it. All right, it's from Todd Sohn. So Todd Sohn showed forward 6 and 12-month returns for the S&P when the VIX is in the second to lowest decile, meaning the VIX is low.
Is that where we are now?
So that's where we are right now.
Okay.
So he says the VIX currently sits in decile 2. Complacency maybe, but forward equity returns are often decent from here. So this is a scatter plot showing the VIX level with the forward returns for the S&P. And looking out 6 months, it's positive 77% of the time with an average gain of 4.5%. Looking out 12 months, it's an average gain of 10.3%, positive 89% of the time. So, this is not like the end of the deal by any
but there's nothing there though. Like,
point
there's
is,
no reason not to buy if that's your concern.
No, a low VIX is in and of itself is not a reason to be bearish. I mean, the VIX have been we've seen low VIX regimes that lasted for like years, right?
Yeah. So it's funny, so people are saying it's like calm, but then other people would take that and say, oh no, actually it's not even calm. It's all the way in the other direction. It's euphoria. So it's saying like one man's calm is another man's euphoria. So I want to share this with you from ChartStorm. The rally off both October lows, meaning the 2023 October low and the original 2022 October low, has triggered a return of euphoria reminiscent of what happened at the start of some of the most significant cyclical bull markets in recent decades.
Okay, there we go.
Meaning euphoria is sometimes how you kick off a bull market. And so this comes from top-down charts, and I want to give people a little bit of an explanation of what this euphoriometer is. It's a combination.
I'd love to. I'm sorry, Josh. It's a euphoria meter. Go on.
I know, dude. I'm joking. But I'd love to give people like some idea of what's going into how he's calculating this.
He wasn't joking.
So it's 3 gauges of investor sentiment. They're using surveyed sentiment, like bull, bear, whatever. They're using forward PE ratio. That's price versus next 12-month consensus earnings. What's being expected, and then they're using the implied volatility or the VIX. So that's like whether conditions are in a panic mode or complacency. And then they're creating a composite based on those 3 things to measure how much euphoria they see in the market. But they're not saying euphoria means the same thing as top. And I think that's like a really big takeaway. But so I don't know if I'd agree that we're seeing euphoria. Maybe in the AI-related stocks, some version of euphoria, but market-wide, I don't think that's how I would describe qualitatively this situation that we're in. There's a quantitative way to say that.
It doesn't feel like euphoria.
I don't feel it either. And when I talk to people, I don't hear it from anyone. All right, I think I'm up. I want to do this thing on record corporate profits. We don't have to spend a ton of time on this, but here's a question for you. What should accompany record highs in the stock market if you want to say, oh, this rally's justified, but not that we care about those things?
Record prices in the stock market?
Yeah, what should accompany that?
Earnings?
Record earnings.
Yeah.
So we are back to challenging record high corporate profits. And I know we've said this before, but I want to say it again. We've seen the bottom in the earnings recession. So Axios did a thing, put this chart up. You could see the change in S&P 500 year over year earnings here. So basically, S&P 500 companies had shrinking profits in Q4 of 2022, Q1 of this year, Q2 of this year, and it looks like Q3 has put an end to that.
Yeah, we did it.
Plus 5.6% earnings growth in Q3 of this year versus Q3 of 2022. So we had the earnings recession. We had 3 quarters of it, and I made this chart, so you'll hate it. Next one.
Don't be soft.
So here's the
Good chart.
2022, 2023 earnings recession as reflected in U.S. corporate profits, which are now $3.17 trillion. That's the top pane. The bottom pane is the S&P. So we paid for it. We corrected both in price but also through time. And that entire 3-quarter profit shrink was accompanied by a market-wide correction. What else do you want? Do you see it the way I'm saying it? We kind of front ran it, and now we're back to that old price high.
So I don't hate this chart. I love this chart. I was talking with Ben today on Animal Spirits. I think a lot of people sort of swept under the rug that were in a long bear market and had a really, really disgusting crash in 2022. Yeah. Like Amazon and Google both went down more than 50%. I think, did Netflix and Meta do 70%? Like it was disgusting. Yeah. And so some
of the biggest companies in America lost half to 2/3 of their market value. So all at the same time.
Like, oh, Meta's up 180% this year or whatever the number is. Yeah, it was down 70% last year. So and then the other thing is this is the 5th longest streak since 1950 without new highs in the S&P 500. The 5th longest.
Yeah. So I mean, we had the earnings recession. The bears were right. And we had the price declines. The bears were right too. You just don't get to be right forever. Like things change. Things come to an end. Is there a story where you get another earnings recession in 24? Like maybe. A believable story, I suppose. The consumer really fucks itself up. Yeah, that's a thing that definitely could happen. There's no evidence of it. And we're going to talk more about that right now. You're up next.
All right. So speaking of no evidence of a recession, let's talk about the holiday weekend and retail spending and all that sort of stuff. By the way, since when does Adobe report on this stuff? This is like everything was according to Adobe Analytics. Is that new? Feels new.
They're very involved in e-commerce, website design. So maybe this is like how they're doing their like info marketing shit. Is they're reporting, they're doing analytics and you know what I mean? Like that's plausible to me.
So here's what they said.
I'm not mad at it.
Online retail sales increased 5.5% year over year on Thanksgiving and 7.5% on Black Friday. And you might say, well, of course, because everything is more expensive and it's all inflated. Actually, driven by deep discounts in categories like electronics and generally lower online prices, which were down 6% year over year. So Cyber Monday will be the biggest online shopping day. Let's throw up this, and it was confirmed by MasterCard and Salesforce and other sites.
It was confirmed by NVIDIA.
It was confirmed by NVIDIA. Look at this next chart. This is the Adobe chart. So Cyber Monday online sales hit new records on big discounts. How about that?
Yeah. So that kind of shatters the inflation narrative.
And then you saw
you're discounting prices back to 2022 levels.
You saw the TSA had the highest daily volume ever. People flying.
The airports had the highest foot traffic ever. Yeah.
Record flying, record spending.
You're getting the bubble.
Record flying, record spending.
Do it. No, but how do you get like the whole? And why doesn't mine do it?
Boom.
There you go. Boom.
Fireworks. And these stocks are working. Shopify is up 110% year to date. Amazon's up 76%.
All of the data sources are corroborating this. MasterCard, like anyone that's tracking the consumer is saying the same thing.
So Josh, let me ask you this: people will not change their spending habits until they get laid off, until we have a recession. I mean, obviously the unknown is like what causes companies to start laying off their employees.
All right. Well, the bear case is that people are now using credit so that they don't have to downshift their lifestyle, which I would say is probably somewhat believable, but it's a huge, broad, sweeping overgeneralization.
Man, if you adjust for disposable income, it's not like off the charts at all. It's very normal.
Yeah, and I think we have very wealthy people who in the last 3 years have gotten wealthier at a faster pace than ever in history. And just when the stock market started to suck, all of a sudden they had this bonanza with yields on their cash. And it's almost like a movable feast. And every year they're making tons of money somewhere else. One year it's real estate. Their home prices can't stop going up. The next year it's cash. The year after that it's tech stocks. It's just like wealthy people and people at the top of the wealth and income distribution are going to keep doing what they're doing until like literally a nuclear bomb goes off. And the problem that you have if you're a bear and you want to make the case that the edges are fraying and that, you know, there's this rising delinquency, whatever, you don't have even a hiccup yet in the labor market. And it's all well and good. You could tell me labor market's a lagging indicator, will be the last place. All right, but you know what? Can you just wait till one person loses their job? Like one net person? We're still printing 200,000 jobs added every month on average. So that's why you're not seeing like the cracks appearing. It's just, it ain't going to happen until it happens. And it will, but I don't know when that is. And you really are missing out on a lot if that's the thing that you're waiting on. So hopefully most people aren't waiting on that. But
well, guess what? By the time you see the cracks, by the time you see the evidence that the economy is slowing down, what do you think will have already happened to stock prices?
Well, we had an economic slowdown.
I'm saying, and stock prices front ran that, and they front ran the recovery.
Right. I think there are people that just mentally have gotten themselves into a state where not only do they need stocks to fall, they need them to fall and never rise, like stay down forever. I think there's like this mentality. Yeah, it's not gonna work that way. I wanted to take issue with the framing in this article. I don't like when they do this. Let me read you the before we get into the charts or anything. Let me just read you this headline. This is Bloomberg, who should know better. And I know the reporter doesn't write her own headline, so it's not a diss. Billions wiped out as stock safety trade on Wall Street misfires. What would you think that article is about? And then I'll tell you what it's really about. Just seeing that headline. What would you think is going on there?
Billions wiped out?
Yeah.
Like people buying like tail risk strategies.
Just people getting killed and like never.
Yeah.
Okay. Here's the lead. Reeling from a bear market last year, beaten up investors decided to send more than $60 billion to ETFs focused on dividends. 11 months later, the trade is misfiring. Rather than give shelter in a stormy season, the largest dividend ETFs have been left behind by a tech-obsessed market whose biggest proxies have surged 15% or more. At the bottom of the leaderboard is the $18 billion iShares Select Dividend ETF, down 5.4% on a total return basis after all-in bets on utilities and financial stocks fizzled. There's just so much wrong with this. I don't even know where to start. All-in bets on utilities and financial stocks, they're not bets. It's an index. There's nobody saying, hey, let's do an all-in bet on financials and utilities. That's what the index is comprised of. Unless that's an active fund that I'm not aware. I don't know. Mm-mm. Is it?
No,
Probably not, right?
No.
Okay. Is it billions wiped out, or is it stocks that just aren't up right now but could at some point go up and then the billions return? Like, what's the right way to frame this?
Technically, billions were wiped out. I mean, I agree with you. That's ridiculous.
Wiped out? Isn't that a lot?
It's a lot.
Like never to be seen again is when I hear wiped out, like FTX shareholders were wiped out.
Right.
Or maybe not.
Wipe out. It's strong. It's strong language. I agree.
I don't like when they do that. Listen, it's one of the biggest gaps between the performance and growth stocks versus value or dividend stocks of all time. The only one that even rivals it is the Mania 1999-2000. Like that's the only thing that outpaces it.
No,
Other than that,
2020.
I don't think so.
Yeah.
I don't think so. I think you're wrong. I think you're wrong. Think about all the cruise lines and airlines and all those stocks rallied into the end of 2020. They did.
No,
Yes, they did. They had huge recoveries. Casinos, hotel. Yes, they did. Yes, they did. This year, it's like pretty much all tech on the leaderboard and a lot of casualties elsewhere. But that doesn't mean wiped out. It just means...
I agree. It's a lot.
Yeah, you're in the wrong sectors this year. It's okay.
Strong language. Very strong language.
All right, go ahead.
So Amazon now delivered more packages than FedEx, which it passed a while ago, and UPS. It's about to pass UPS. This is kind of incredible. Like they were showing a statement from Fred Smith, the founder of FedEx, like scoffing at the fact that like Amazon would never be able to get into that business and meaningfully compete with them.
Yeah, I put that here.
If you were like an early Amazon shareholder or bear, whatever, like there's no way that you could have foreseen this. That now they're like the biggest logistics company in the world, shipping company in the world. It's like incredible.
Yeah, and they're not only shipping their own stuff, but that's a huge business for them, is third-party shipping and logistics fulfillment. And that's one of the things that they're fighting an antitrust battle over. Sellers on the platform basically saying, or lawyers for those sellers basically making the case that like you almost have to use Amazon. If you're selling on their platform, you have to use them for shipping.
I like Ben Thompson's case on this. Ben Thompson's like, they built the system. Like, why should they take the chance that you're going to be able to, that you're going to be able to ship it effectively and ruin their reputation?
That's what Amazon said. We tried to leave it up to the sellers, and they couldn't do it as well as we did. And these are our customers, so kiss my ass. Like, if you're selling on our platform, it's our job to make sure that the client gets their stuff. All right, what are the numbers here? This is. Put this chart up. Amazon is in blue. It is crossing over UPS. It is long since crossed above FedEx. This is in parcel volumes. So we're talking about in the 5 billion parcel range, I guess, per year. This is on 5.3 billion UPS shipped last year. And Amazon is now growing above that. That's insane. I mean, I see the vans all over my neighborhood. Shouldn't be that surprised.
Did you know that
Put this next.
This news to me? FedEx is up 48% year to date.
Yeah, I think it had a really tough year before though. So did Amazon, and Amazon's up 77. UPS is a shit stock this year.
Throw up the next chart, please. The revenue chart. So these are both. So we're looking at UPS and FedEx revenue quarterly, and these are both well off their highs. And I don't know if this is because Amazon is coming in there, but the Journal said in recent years, UPS leaned into higher margin parcels from other customer segments, including healthcare and smaller businesses.
Mike, I think it's pandemic related, because if you look at their revenue, 21.6 for FedEx and 21 for UPS, they are well above 2020. Prior to the pandemic, like the end of 2019, like that looks normal. What happened in 21 and 22 with everybody having to ship everything was like not going to be repeated.
Yeah, you're right.
So I want to get into some really funny stuff though from 2013. Bloomberg, there were leaked documents from 2013 predicting this. Bloomberg got a hold of these internal Amazon documents 10 years ago. The project internally was called Dragon Boat. And this is them. Said it's intended to launch a new business called Global Supply Chain by Amazon as soon as this year, and would compete directly with companies like FedEx and UPS. The document describes Dragon Boat as a revolutionary system that will automate the entire international supply chain and eliminate much of the legacy waste associated with document handling and freight booking. All right, so that actually did end up happening. This is a 2016 Wall Street Journal article where they got competitors to weigh in on how serious Amazon was as a threat on shipping. Memphis-based FedEx says it's spending more than $5 billion annually on expansion and upgrades. I guess that was a lot of money back then. UPS says it shells out in excess of $2.5 billion. The two companies have managed to blanket the world with a total of 4,000 hubs and facilities. They operate 200,000 vehicles and 1,000 planes. Quote, the level of global investment in facilities, sorting aircraft, vehicles, and people to replicate the service we provide or our primary competitor provides is just daunting and, frankly, in our view, unrealistic. That was the CFO of FedEx 8 years ago. Well, guess what? Literally, it happened.
But totally reasonable thing to say at the time.
Yeah, I agree. I totally agree. The UPS guy, chief commercial officer, said our network would be, quote, very difficult to match. Match? How about exceed?
But again, the idea that Amazon would be able to disrupt the two largest and I don't know if they're the oldest shipping companies in the United States seemed preposterous.
Yeah.
And they did it.
They did it. Zerp helped, but it happened. And we're seeing this everywhere. Tech versus everything else. We're seeing this in pharmaceuticals, seeing this in automakers. Big rising stock prices are enabling companies to replicate things that 10 years ago we would have thought were unreplicable, if that's a word. All right, we're going to do here's my big takeaway. There's always a bigger lion in the jungle somewhere. And the other one, don't underestimate the potential for your biggest customer becoming your biggest competitor if the money that they'll save is meaningful enough. So Amazon was at one time, Amazon was FedEx and UPS's best customer, but there was too much money to be saved by competing with them rather than utilizing them solely. And Jeff did it, and he wasn't very stealth about it. He bought himself thousands of airplanes and trucks and built them, and here we are. It's a pretty amazing moment. Okay, you're going to make the case? What do you got?
I am going to make the case that we, not just you, myself included, because I do buy individual stocks, we should be careful buying individual stocks. And what I'm about to talk about has nothing to do with the psychology of battling yourself, the difficulty of riding winners, the ease with which we just ride losers and hope for them to come back. Like, put all of that to the side and just literally
Which are very real things, by the way.
Which are very real. So hold that to the side. That's not even enter the equation for today. So this chart is showing the percentage of S&P 500 stocks outperforming the index. And this is year by year. And some years it's higher than others. I don't know what the average is here, but most stocks do not. And this is just on a yearly basis.
The average looks 48% That's the percentage of stocks outperforming the S&P itself.
If you were to extend this to 2 years, to 3 years, to 5 years, the number just goes lower and lower and lower. I wanted to share two.
Wait, hold on. Last year, 58% of S&P 500 stocks outperformed the index itself,
and everybody was so happy. Just kidding.
Which was, everyone was miserable anyway. But that was pretty high. This year, only 24%. So that's an apocalypse for stock pickers.
Horrible.
That's bad, dude.
Horrible. This is a great chart, a really, really interesting chart from Morgan Stanley that Carl Quintanilla shared. I've never seen it put this way. What we're looking at here is S&P 500 companies. It's the years to spend their market cap on CapEx and R&D. And NVIDIA, as much as they're spending, it's 131 years. Tesla, it's 69 years. Very nice. The S&P 500 on average is 49 years. Look what Tesla, we spoke about this a couple of weeks ago. Look what Tesla did to poor Ford and GM. GM and Ford spend their market cap in 1.9 and 2.6 years respectively.
I think you're reading this backwards. Tesla did not spend its market cap 69.4 times.
That's not what
is saying. Okay.
That's not what I said.
All right, so maybe I don't understand it.
Okay. So it would take 69.4 years based on their current run rate for Tesla to spend its entire market cap, which is a sort of a funky way of
yeah. Okay.
Which is a funky way of thinking about it. But Ford and GM spend their market cap on R&D and CapEx in 1.9 and 2.6 years respectively.
Yeah, it's crazy.
This cannot continue. And this
No,
is what
it's unsustainable.
This is what Nick Cola said about the market saying that Ford and GM will not be in business in 10 years.
Dude, people get so angry at that idea because it's like a big piece of their lives. Like Ford and GM and like people are like really invested in these brands, and their daddy had the pickup, and it's like a whole thing, and they just don't want to contemplate a world where those companies basically become IP providers and somebody else is making and selling their stuff for them. Like I'm not saying it's going to be like next year, but that what you just put up there, it's a pretty unsustainable situation.
One more thing that I thought was super fascinating from, I think his name's Tom Reiner at Altimeter. He looks at public market run rate dilution, and he broke it. He broke it down looking at big tech, and software, and internet stocks, and non-tech, and he said it's wild to think that Lyft is diluting at 9% per year. The market capitalization of the business would need to double just to keep the stock price flat over an 8-year period.
Why are they doing that? This is compensation
It's equity
for employees?
comp. It's equity comp. So next chart, please. So this breaks it down looking at software stocks, internet stocks versus large cap tech and non-cap tech. And even like he made the point that even Facebook, which is like got an air quote fit and really right size its equity comp, is still diluting its investors to the tune of 2.8% a year. And this is, again, it's something that really, last chart, it's something that like when you're picking stocks, and listen, this definitely doesn't matter over the short term, like literally at all, but it really matters. Like if you're buying and holding stocks, this actually matters. So he's got a chart that shows the 5-year market cap growth to offset the dilution. And if you're diluting at just 3% a year, which doesn't sound like a ton, that's a 16% market cap growth just to offset all the shares that you're issuing.
So
again,
the tech bulls would say, yeah, of course these companies are diluting at that rate. How do you think they're able to hire AI talent? The average AI worker is a $5 million salary, or a $5 million comp package. What do you think that's like W-2 income? Are you kidding me? This is what we have to do in order for the company to survive. We're in the software business.
But so PayPal is 0.9%, Etsy's 1.8%, DoorDash is 4.7%, Snapchat is 7%. Like there are, I mean, that's crazy shit.
And most of those companies you just listed are not growing their market cap.
Right.
Like they're just not.
And so then you think about Apple, which is doing the exact opposite.
All right. So
just buying back gobs of stock.
So we got to make the case from you, and we got a couple of bonus charts. I love it.
Go ahead.
Let's do a mystery chart, and then we'll get out of here for the night. I feel pretty good about you getting this one. I do. All right, let's throw up. I have 2 of these. It's the same company. I'm just showing you 2 different time frames. Let's do, what is this one? All right, this is the 3-year, or the 5-year rather. This has been quite a ride. This is one stock. It's not an index. It's nothing convoluted.
Okay, looks familiar.
And I'm giving you prices too. Okay. So I'm like really, all right. Now give me the year to date. This is a really big story this year. This is percentage gain and price. So there's a stock that's gone up. It started the year at 30. It's in the 70s. It's 112% gain, and we sort of alluded to the sector earlier in tonight's show. You want to take a guess?
That is a ridiculous looking chart. I mean, so we alluded to the sector. You gave me the price. Can you give me anything else?
I can. I would like to tell you that the news about Black Friday sales hitting a record, very relevant to what's going on with the price of the stock.
Okay. I got you. Yeah, I got it. This is Shopify.
Attaboy, look at this. Do we have confetti for young Michael? All right, round of applause. That's good, too. Chart off. I told you that I thought this would be a buy now, pay later Christmas. When you have credit card rates pushing 30%, people who want to buy things for their loved ones aren't going to stop buying things. They're going to get smarter about how they pay for them. And that is what's powering some of the moves in a firm that we're seeing.
Can I tell you something?
I think, yeah, please.
2 things. Number one, if you look at I'm looking at a chart of Shopify. yeah, it's up 100 whatever percent year to date. This thing is a disgusting dog of a stock. If you just look at the stock chart,
Not if you bought it in January, it's not.
Exactly. But tell me when you would have bought this just looking at technicals. This thing is so gappy and all over the place and massive drawdowns. Just an impossible ride. But anyway, I did my first buy now, pay later transaction. Actually, that's not true. I did it. The Peloton I bought now and I paid over, 24 months. I don't know why I decided to do it today, but I said, I'll pay it over 6 weeks. Why not? No interest?
It turns out I am constantly using Shop Pay without even realizing it. And I'm getting these alerts from them, like when things are being shipped, blah, blah, blah. And I click back on the link, and it shows me, like, I just bought 15 things this year using the Shopify Pay feature just because that was what was right in front of me on the website. So, like, Shop Pay, I don't know about, like, all the shipping and stuff. Like, I'm not going to get into that whole conversation right now, but, like, just the Pay feature. So
but isn't that what killed PayPal?
Something going on here.
Like, it usto be PayPal. Now it's
Apple,
everything. It's Apple, it's Google, it's Amazon.
It's not everything. There's going to be like 4 or 5, but to a greater or lesser extent, they're disintermediating the credit cards that used to own the online commerce business. And if more people decide to do buy now, pay later versus carry a huge credit card balance, that is somewhat of an existential threat to some of the credit card issuers. So worth keeping an eye on what a firm is doing, because it's not just hype. There's something going on there. All right, and we'll end with that. Hey, guys, did you know tomorrow is Wednesday, which means another all-new edition of my favorite podcast, Animal Spirits with Michael and Ben. Check your podcast app. Make sure to listen. And then later this week, I don't want to overstate this, but
however,
oh my God, Michael and I, we're not going to say who. Michael and I have a very, very, very special guest. We are so excited, and that'll come out on Friday. Okay, thanks everybody for listening and watching. We appreciate all the likes. We appreciate all the comments in the chat. We'll see you soon.